Have you ever wondered how banks make money when they're literally paying you interest? I mean, are they just super generous billionaires handing out free cash like Oprah? You get 4%. You get 4%. Sounds like a terrible business, right? But here's the plot twist: banks aren't playing charity. In fact, they're one of the most profitable industries in the world. Yeah, even more profitable than some Hollywood blockbusters. While you're watching The Wolf of Wall Street, these guys are quietly becoming the wolves of your wallet. Today, we're decoding the real business model of banks, and spoiler alert, it's way crazier than that scene in the movies where the vault door swings open to reveal stacks of cash. Reality? Way smarter, and sneakier. Hey friends, welcome back to Finance Decoded, where we break down how real-world businesses actually work. Today, we're diving into a business that literally touches everyone's money: banks. By the end of this video, you'll understand how banks use your money to make billions. The illusion of safekeeping. Alright, let's talk about something we all think we know: our money is sitting safely in the bank, right? You know, tucked away in a giant metal locker, locked up tighter than a vault in a spy movie. Well, guess what? That's not how it works, and your money's probably doing a little side hustle of its own. Here's the deal: when you deposit your hard-earned dollars in the bank, you're not just letting them chill out in the back room like that one guy who never gets invited to the party. No, my friend. Your money goes on an adventure. Let's break it down. Say you walk into the bank and hand over $100, your sweet, shiny, $100 bill. The bank's like, "Thanks for the cash. Here's 4% interest for you, buddy." And you're like, "Cool, 4%, that sounds nice." But here's the plot twist: the bank's not just giving you 4% interest and calling it a day. Oh no. They take that same $100, and guess what? They loan it out to someone else. Imagine this: some guy comes in to buy a house, and he needs $100. So the bank says, "No problem, have it. But hey, we're gonna charge you 8% interest on that loan." Wait, what? That's right. The bank's charging someone 8% to borrow the $100 you gave them, while they're only paying you 4%. Do the math, folks. The bank just pocketed a nice $4 profit. So, here's how it works in a nutshell: your $100 is out there buying houses, living the good life, making new friends. And the bank is sitting pretty, collecting 8% interest, handing you a little 4% as a thank you, and taking the rest for themselves. It's like they're hosting a party with your money, but you didn't get the invitation. The bank keeps most of the cake and gives you just a little slice. But hey, it's still cake. What if you want your money back early? Alright, now let's talk about the fun part, the one that no one tells you about until you really need your cash. What happens if you deposit, say, $100 in a bank, and then, out of nowhere, you have this sudden urge to buy a new iPhone? And guess what? You want that $100 right now. Here's the catch: no bank in the world is sitting on all the money you've deposited just waiting for you to come back with a "gimme my cash" demand. You think they're holding on to your $100? Nope. They've probably lent it out to someone buying a house or a car, or maybe even that guy who definitely shouldn't be buying a Lamborghini on credit. Explain. So how do they do this? Well, the US Federal Reserve says banks need to hold on to a certain amount of cash. But not all of it. Just a fraction. Here's the breakdown: 4% cash reserve ratio, CRR, which means, out of every $100, the bank must keep at least $4 in a vault somewhere. The rest? Let's just say, it's working overtime. 0.18% statutory liquidity ratio, SLR. This is the extra cushion the bank must keep in the form of things like government bonds, gold, and maybe even some luxury assets, probably not your collection of Funko Pops though. That's $18 of your $100 locked up in safe stuff. So in reality, only about 78% of your $100 can be loaned out to people buying houses, cars, or, let's be real, expensive coffee machines. That means, if you try to take out all your cash at once, well, good luck. They've probably given most of it to someone else. What is a bank run? Okay, imagine this. You walk into your local bank, maybe JPMorgan Chase or Bank of America, and you want to withdraw your money. But then the person behind you also wants their money. And the next person. And the next. Pretty soon the line's wrapped around the block like it's Black Friday at Walmart. The problem? The bank doesn't have everyone's money. Why? Because banks in the US do what banks everywhere do, they take your money, loan it out, and earn that sweet interest in between. Let's say you gave the bank $1,000. They gave $900 of that to someone else who wanted a car loan. You earn a tiny bit of interest. The bank earns a bigger slice. Everybody's happy, but what happens if suddenly everyone wants their full $1,000 back at the same time? Spoiler alert, the bank doesn't have everyone's full $1,000 in cash. Enter, bank run. That, my friend, is called a bank run. It's not a marathon for rich people. It's when a lot of people freak out, panic, and try to withdraw their money all at once because they think the bank might collapse. Even the big boys, like Bank of America or JPMorgan Chase, would be in trouble if millions of people showed up screaming, "Give me all my money now." Because, again, they don't keep it all in a vault like some Scrooge McDuck gold swimming fantasy. The safety net, FDIC to the rescue. Thankfully, in the US, there's this superhero organization called the FDIC, Federal Deposit Insurance Corporation. Think of it as insurance for your dollars, like a safety net for your savings if your bank decides to spontaneously combust. The FDIC insures deposits up to $250,000 per person, per bank. So even if a bank fails, your money is probably safe, as long as you didn't stuff your $1,000,000 mattress into one account. Moral of the story: so, the next time you hear that your bank might be in trouble, just remember, bank runs are like the worst kind of flash mob. Except no one's dancing, and everyone's stressing. But don't panic. The Fed has your back, just like a financial bodyguard in a suit. What about countries with low interest rates? Alright, let's talk about those magical places where interest rates on loans are so low, they might as well be giving out free money. I'm talking about countries like Germany, where home loan rates are around 0.5%. That's less than your average cup of coffee. Seriously, it's like paying to borrow money. So, how do banks make money when they're charging people next to nothing for a loan? Is it like a charity at that point? Nope. Here's how they work the system. Savings accounts at 0%, or worse, negative interest. First, they get us where it hurts, our savings accounts. They're offering 0% or even negative interest. So, you're literally paying them to hold your money. Imagine going to a bank, depositing $100, and them saying, "Thanks for the deposit, here's your receipt, and we'll charge you $1 for that privilege." You're paying them to keep your money safe. Does that sound like a good deal? No. But banks make it happen. Monthly maintenance fees, because why not? Then, of course, there are those sneaky monthly maintenance fees. You know, like the $5 you didn't know you had to pay just for having an account. It's like a subscription fee for your money. You're basically renting your bank account. Thanks for being a customer, now pay us to let you keep your money in our vault. Oh, and don't forget about the extra charges if you forget to meet their minimum balance, or if you breathe too loudly around your account number. Investments, because banks can't just not make money, and don't forget the classic, banks invest your money. They're not just sitting on their hands, twiddling their thumbs, hoping your pennies pile up. Nope. They're making moves, investing in stocks, bonds, maybe even gold. Anything to get a return. You know, it's kind of like how your friend insists on putting money into crypto to make it big, but this time, it's the banks who are the ones getting all the gains while you get 0% interest. So the next time you toss your hard-earned cash into the bank, just remember, you're not parking it in some cozy vault. Nope, you're basically funding a massive loan factory. Your money's off to buy someone a house, a car, or maybe even a pet giraffe, who knows? Either way, you're not just a saver, you're an investor in the world's sneakiest side hustle.